Bloomberg Audio Studios. Podcasts, radio, news.
This is the Bloomberg Surveillance Podcast. I'm Jonathan Ferro, along with Lisa Abramowitz and Anne-Marie Hordern. Join us each day for insight from the best in markets, economics and geopolitics. From our global headquarters in New York City, we are live on Bloomberg Television weekday mornings from 6 to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app.
This from Axios in the last 24 hours on Treasury Secretary Scott Bessent. Here's the quote. The Secretary isn't happy. He let the President know.
This is something that people keep talking about. His concern was that it was going to royal markets. It would be counterproductive and that it would actually make it more difficult for them to nominate someone who would be more Trump-friendly to the Federal Reserve, which seems to be exactly what is happening.
Joining us now is Patrick McHenry, the former chair of the House Financial Services Committee. Patrick, welcome to the programme. This pursuit of the Federal Reserve, does it introduce some financial stability risk?
Clearly. And this is the reason why you're reporting, we just heard about Secretary Bessent telling the president directly his displeasure. Look, the substance of the question here is whether or not the chair of the Federal Reserve lied before Congress. And what I would tell you is, having experienced multiple dozens of testimonies by various Fed chairs, the Fed chair coming to Congress is the most briefed person that appears before Congress, period. The briefing book is really the question here, not the Fed chair. Was the briefing book appropriately written to answer members of Congress questions about the building project? I believe it was, and the amount of discipline the Fed puts into ensuring they have an accurate briefing book for the Fed chair, for any Fed chair. And I think that's the missing nuance of this story. But there is no nuance here. The president's flooding the zone on economic issues to open the year. We're going to see a whole lot more of this in the coming weeks, but he's coming out guns a-blazing with both progressive, populist and conservative and market-shaking ideas all in 1 week.
Patrick, you spent a ton of time with the Fed chair. Actually, he has a ton of political capital on the Capitol. He spent a lot of time with Republicans and Democrats. Do you think that that's what we're seeing played out right now? All those meetings he has taken, all the political capital he put into going into meeting senators and meeting House members. When you hear Senator like Kennedy saying, we need this like we need a hole in the head, it sounds like they are upset with what the DOJ is doing.
Yes, and that is exactly what you're saying. This is why we got to listen and watch Bloomberg, because this is the type of nuance you need to understand. The Fed chair puts an enormous amount of time each week into ensuring his relationships around Washington, D.C. I'm the beneficiary of that with the last 4 Fed chairs in my service in Congress. And it means that if there's a jump ball, you give them the benefit of the doubt because you have a relationship with them and you know them. That's the goal. It doesn't always work. The outreach doesn't always work. It doesn't mean you have a good relationship. But at the very least, the Fed chair and all Fed chairs have put a lot of effort into ensuring they have relationships on the Hill, that they have political capital in the tank, so that when times get sideways or bad, they will defend you or be helpful to you. And this is a moment where you see that Jay Powell's put an enormous amount of equity that he's built up on the Hill on both the House and Senate side, both with Republicans and Democrats.
Some market participants say that because of what is going on, he's going to stay on the Federal Reserve in his governor's seat till 2028. If he were to do that, do you think Republicans will actually view that move as him being basically not withholding up to the independence of the Fed, because it's very non-traditional for a Fed chair to do so?
Well, it's a term of office, number one, and number two, a tradition that former chairs roll off the Fed board. It's a good practice for former Fed chairs to roll off the board. It allows their successor the time and runway to get up to speed. But in this case, these are I would say at this phase threats to counterbalance the president and the Department of Justice's threats here. And that shows that Jay Powell is not powerless in this situation. The Federal Reserve is not powerless in this situation. That's one element of it. The other element of it is that is clearly saying to the White House, think of your nominees. Think of your nominees that have to go before Capitol Hill in this context. And I think this means that the president's first nominee to be chair of the Federal Reserve is going to have one heck of a time dealing with members of Congress, given this context of DOJ intervention.
Stay with us. More Bloomberg surveillance coming up after this. So here's the latest this morning. US productivity accelerating at its fastest pace in 2 years, fueling hopes for further AI-driven gains. Nouriel Roubini is the chairman of Roubini Macro Associates, and he writes the following. The US remains at the center of a technology-driven positive supply shock that raises growth and lowers inflation over time. Nouriel joins us now for more. Nouriel, good morning. Good to see you.
Great seeing you.
Fantastic to catch up with you, sir. You're bullish, not just for the year ahead, but through to 2030. Can you flesh that out for us a little bit more?
Yes, I mean, everybody's talking about AI, Gen AI, but this is only one of the 15 technologies of the future. They're all related to AI, but it's AI, semiconductor, biomedical research, quantum fusion, defense tech, fintech, new material science, you name it. And it's a race between US and China. I don't think it's a zero-sum game. US is going to do well, China is going to do well. But my estimate is that the US potential growth is estimated today to be only 1.8%, could be as high as 4% by the end of the decade. And I've done a bit of a bottom-up analysis. And by the way, the data on productivity, after the GFC, average productivity between 2009 and 19 was only 1%. Since 2019, in spite of the dip during COVID, has doubled to almost 2%, 1.9. In 2024 was 2.4%, and the number from Q3 suggests was almost 5%. And by the way, the Atlanta Fed nowcast for Q4 GDP as today is 5.1%. Probably it's too high, but given that one, given the job number, you'll have another high productivity growth. Now, I don't think the productivity growth is 4% or 5%, but there is definitely acceleration.
Jobs is key. Is it jobless growth? So-called jobless growth.
Yeah. Well, it's a jobless growth. There are three stories. One is that the GDP numbers are wrong, and the GDP numbers are going to be revised towards the weaker labor numbers. The other one is that, no, the GDP growth is strong, and you're going to have some adjustment upward of the revised data. I think the third explanation is the more correct one. You can have strong GDP growth and having weak labor growth because we're having a productivity revolution. If you're looking, for example, at the revenue, real revenue per worker of S&P 500 firms since the launch of ChatGPT in November 2022, the average has increased for S&P 500 firms by 15% in the last 3 years. So it's almost 5% per year. And if you look at it by sector, of course, a lot of it is closer to 20% in tech and communication services, but it's very large also across the board. So both at the micro data level, S&P 500 firms, and the macro number, we're seeing a productivity revolution already in the numbers.
I'm kind of dealing with whiplash right now because we just had the Rheinmetall CEO on, defense sector in Europe booming for all the wrong reasons. This idea that he's more worried about the state of the world than ever before. And here, Dr. Doom is coming on to tell us about how productivity boom is going to bring everything to a better place. Why are you less concerned about this overlay of rearmament and militarization that is also coming in tandem with this productivity boom?
Well, there are geopolitical risks in the world, and I'm aware of them. The question is whether they're going to have a significant economic and market effect. Look at the biggest one. You had a 12-day war between Israel and Iran last June. Oil prices went up a little bit, stock markets wobbled. And then, given that Iran did not attack the oil facility of the Gulfies or block the Strait of Hormuz, it went away. And that was a big deal. Venezuela, we can discuss it at length, but the macro and market implications are close to zero. It's just less than 1 million barrels a day. Russia-Ukraine is a mess, but it's not going to have an impact on global market economy the way it did in 2022. So, and US-China, they are, of course, in a competitive strategic competition, but right now the trade tension, for all the reasons we know, are somewhat limited. So every time there is a geopolitical risk, people say stuff could happen, but so far, those that we have seen in the last few decades, leaving aside the 70s with the shocks of Yom Kippur and the Islamic Revolution, have not a market effect.
Do you think, though, that the United States is going to lose some of its luster as an investment haven in terms of the ongoing conflict between the U.S. and traditional allies like Europe? I mean, have you seen anything like that, or do you think that's overstated and productivity really is going to rule the roost?
You know, I've been saying since last year that tech trumps tariffs, because I think that the upside coming from tech is 200 basis points. Well, if you add all the impacts of the bad stagflationary policies of Trump, trade, restrictions of migration, fiscal deficit, trying to affect the independence of the Fed, the rule of law, the maximum from an empirical point of view could be a negative 50 basis points downside to potential growth. So you have an upside of 200 from technology, you have a downside of 50, is a ratio of 4-1. So tech trumps tariff. So the stuff that is technology is first order, everything else, including geopolitics, is second order.
Is this why the AI trade, the market pretty much shrugged off at independence yesterday as a serious concern?
You know, I believe that, you know, there is some frothiness, of course, in the AI sector, but if you talk to all these companies, I think that they would all argue that we are maybe at worst 5 years away, or at best 3 years away from AGI, however you want to define it. Now, if we are achieving artificial general intelligence, the valuation of the, say, of not every of the Mach 7 is going to reach AGI, but maybe 3 or 4 will. So the value of a firm that's going to be having AGI is going to be 5x of its current value. So that's the race. So if you think of it this way, yeah, there is some frothiness, there can be a correction, but with U.S. growth at 2% for the last few decades, the average return on S&P 500 was 12%, including dividends. Of NASDAQ was 16%, and those with 2%. Suppose growth is not 2, 3, let alone 3.5, 4. American exceptionalism has to become even stronger, because if it was American exceptionalism with 1.8% growth, with higher growth, it has to be better than that on average. Now, there'll be winners and losers, both within publicly traded firms, old economy versus new economy, and among the startups. Many of them are going to go bust. But if you're looking at the medium-term horizon, with higher growth, you're going to have higher returns. And we're seeing, based on the data on real revenue growth for S&P 500 firms, that most of those productivity gains are gotten by the firms. Real wages are growing less than productivity, unit labor costs are falling. That's why there is malaise. That's why people are worrying about affordability. But from a profitability point of view, the corporate sector is doing great.
Stay with us. More Bloomberg surveillance coming up after this. Tiffany Wilding of PIMCO joins us now for more. Tiffany, welcome to the programme. We'd love your view on, one, the data we just got, but two, the outlook for inflation. Is there a better story to tell?
Yeah, well, I mean, it sounds like it was a very mixed bag, as Mike McKee just described. It seems like the softer than expected numbers came really from the good side, and even on the good side, it was very much a mixed picture. So you have tariff-related pass-through that's happening at a very uneven pace depending on industry. So you had electronic products, that appeared prices were down quite a bit, but other things like apparel were up. So it's it looks like a pretty confusing number, quite frankly. And on top of that, you did have government-related distortions because of the shutdown. So I think the Fed will have to parse through this. The way that we read the tea leaves more recently is that after 75 basis points of cuts that they've implemented in the second half of 2025, they're much closer to neutral. They're on the higher end of their own range, estimated range for neutral. And as a result of that, with the labor market stable, they're pretty comfortable pausing here to just get more information and see what happens.
It was quite a confusing number, is an evergreen statement for the past 12 months and probably the next 12 months of data that we're about to get, Tiffany. I just wonder, when do you think that we will get a number that is not confusing, that gives us a little bit more information, given the fact that this is a muddied economy with slow hires, slow fire, the idea that maybe you're getting disinflation, you're not getting a jobs recovery, but at the same time, you're getting growth?
I mean, so I do think that, we've heard from various, companies and other industry sources that the holiday shopping season was going to be a key season where they were trying to hold prices, maybe even, elevate discounts in order to gain market share. And then more potential tariff pass-through would be likely in the first part of next year. We also had an inventory story. You had a bunch of stocking ahead of tariffs. Companies were holding higher inventories. And some of that was probably getting them through the holiday season. So I think it's really going to be a little bit of a test, early next year, to see how companies react to this new regime. The other part of this, of course, is that we have a Supreme Court decision coming out that will have implications for tariffs. The administration has talked about rebuilding the current regime, even if the Supreme Court strikes down, the tariffs on legal issues. So that adds a wrinkle to this. And then the final thing that, will have material implications is that we do have offsetting fiscal stimulus that's coming. This will be one of the biggest refund tax seasons in recent memory. So the economy overall doing strong. There are winners and losers under the surface, and on top of that, we are getting some fiscal stimulus. So we'll have to see how inflation evolves amid all of those factors, we think, early next year.
Which sector of the economy?
This year, excuse me.
Which sector of the economy, Tiffany, do you think is going to drive inflation, given the fact that people don't think it's going to come from housing? And so far, it hasn't really come from manufacturing.
Yeah, well, so I think that the labor market as well is not really a place that you're seeing inflationary pressures. It's really the wealth effect right now that appears to be driving, elevated domestic demand, more resilient consumption than I think anyone was expecting. We're tracking consumption growth in the second half of the year, 2.5%, and that's at a time when you have real labor income growth at 1%. So you're clearly getting a wealth effect here that's keeping demand elevated. So that appears to be the source of demand and some potential inflationary pressures. And just how that comes out in the data, again, it's a winners and losers economy, and that should be reflected in the CPI as well. The housing side has been a relative loser here. It does look like to us that rents will moderate, quite dramatically. We think they could be below a pre-pandemic trend. But on the other side of that, you are still getting some of this tariff-related pass-through that's keeping core goods elevated. That should peak in the first part of this year and moderate thereafter. But in the meantime, we are still getting it.
Given this latest data, do you think it opens the door for the Fed, maybe not to cut, but to be dovish?
I think that the Fed will, I think they certainly will, they will. They will say that inflation, has looked better than expected, and I think that's absolutely right. So with that, I think there's certainly reason for them to have an outlook of continued interest rate cuts towards their estimates of neutral. So I think the conversation, from Federal Reserve officials is throughout this year is really going to shift from, where do we think neutral interest rate policy really is at this point? I think after the tariff-related price adjustments happen, underlying inflation, does look pretty good here. And so when you have inflation that's getting close to target and a labor market that's stable, you really need to think about where is neutral policy. So that's the conversation we think they'll be having in 2026.
This is the Bloomberg Surveillance Podcast, bringing you the best in markets, economics and geopolitics. You can watch the show live on Bloomberg TV weekday mornings from 6 a.m. to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app.